Propertyology regards right now as a very exciting time for investing in Australian real estate. There are some fantastic opportunities that Propertyology can help you take advantage of before buyers re-emerge from their coronavirus cocoons. Propertyology has a national focus. Now more than ever, experience and knowledge are the most valuable currency. Propertyology has that in spades. To find out how Propertyology's multi-award-winning buyers agents can help you prosper, contact them now at propertyology.com.au.
Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. Phil Tarrant here. Welcome to the Smart Property Investment Show. Thanks for tuning in today as we navigate property and property investment. And today, in particular, we're back. Portfolio update. This is when we deep dive into the Smart Property Investment portfolio. It's what we love to do. There hasn't been a lot of activity going on in terms of buying in this portfolio recently, but what we are really keen about is understanding and mapping the portfolio moving forward, its performance and sharing it. If you're new to Portfolio Update, it's been a mainstay of Smart Property Investment for many years now, even when back in the day when we were a print magazine and we purchased our first property back in 2011, which is nearly 9 years ago now, which is absolute madness. And I've asked someone in the studio there that was there on that first day and helping us navigate property then, as he is now, Steve Waters from the buyer's agent, Right Property Group. How you going, Steve? You well?
I'm going well. I can't believe it's been that long.
I know. So I was just literally, I've got a big spreadsheet here in front of me, and our first purchase, settled date, August 2011.
It really does just seem like yesterday.
That's 9 years ago.
I know, right? Don't look a day older, just saying.
I look pretty good.
I was actually talking about myself.
Oh, really? I remember traipsing around auctions with you out in St Mary's, and where did we go?
I remember we went to a
St
McDonald's
Mary's, not
somewhere.
St Mary's Band Club. It's got its own postcode.
Its own postcode.
What's the name of the big RSL out there? St Mary's RSL?
Reedy Hill?
Reedy Hill RSL, was it?
Yeah. I remember signing contracts. We were signing contracts after an auction. Where was it? It was like on this really bad excuse for a table that was half falling over somewhere. Yeah,
great. It's the way it should be.
Memories.
It's the way it should be. That first property way back when. Yeah, nearly 10 years ago. Madness. Absolute madness. And that, Stephen, was a 2-bedroom property.
St Mary's. Let me guess. St Mary's. North St Mary's.
It was in St Mary's. Malley Street.
Yep.
North St Mary's.
Corner block
that we did a reno on. And that was the start of our portfolio, which today, I'm looking at this spreadsheet here, is 18 properties, 18 income-generating properties. And most of them are generating income at the moment. I've got a couple of little red colours on some things of stuff which is vacant, which we can have a chat about today. But it's been a little while since we've done a portfolio update, so we want to be doing this monthly, and there are going to be a whole bunch of different things. It might just be musing about the portfolio. I'll get some of the people in who have helped us build this portfolio over time, including Steve in the Right Property Group, who's been there across the purchase of the properties in this portfolio. And even then, Steve, when you look at the last property we've purchased, and this goes to show, October 17.
Is that right? It doesn't feel like that.
Yeah. What's that, 2.5 years ago?
Yeah, it's a bit sad.
It is, isn't it?
But there's a lot to talk about. There's a lot going on. There's a million pieces to this portfolio.
There is a million pieces to this portfolio, and that was in October 17, and we just didn't buy one. We bought 5 in a row. I remember the purchase of these because we're trying to do all these 5 properties sit in one trust. However, we have 3 different lenders for the 5 properties.
And different titles, yeah.
And different titles. So it was a strata block rather than just one purchase. So we had to get a different mortgage for every single one of those assets. They were $190,000 each by memory. Yeah, so I remember actually I was in San Francisco doing some stuff in a pub in the middle of it was probably 9 o'clock at night. Just wanted to have a nice cleansing ale after a hard day's work, and I was on the phone back here to Australia trying to work out the funding of these things. So the trials and tribulations of a property investor. But if you've been tuning in, go and check it out on smartpropertyinvestment.com.au in our portfolio section. We call it investment in action. A lot of the stories as we built out this portfolio, and we've been a bit light on recently purely because of the mechanics of the portfolio. We haven't been actually acquiring in this period of time. We've been managing, and whether or not, Steve, we've been managing it effectively is probably for a discussion today. So I think this allows us, much like COVID-19, is allowing us to rethink, reset where we are with this portfolio and work up a plan into the future and how it looks. But to give us some sense of, and if this is the first you've heard me talk about the portfolio, we do enjoy doing it. We have been doing it from an absolute get-go. So there's heaps of stories around it. But the purpose of this is that Well, the philosophy of this is way back when we started Smart Property Investment is that we looked at what was out there in terms of information, and it was before podcasts, and even the interweb was still,
infancy.
It was sort of infancy back then, and a lot of people got their information through magazines and books and stuff in property investment or seminars. So, from when we started investing in property to where we are today, it's a completely different paradigm in how you get information. And I like to think that we've been a driver in shaping the way in which that works. And I'd like to think today more than ever before, property investors are more informed, right? Like compared to 10 years ago when it was like a secret that you could only untap if you paid some guy $10,000 at a seminar, right?
Without doubt.
Without doubt. So, but we started this, we just went, you know what? We looked at what was out there, and this is sort of back in 2009, I think, when we kicked off Smart Property Investment. We just don't believe a lot of the stuff that we hear. There's a lot of BS out there. Everyone was getting rich. Everyone was becoming a bazillionaire overnight in property. And we went, the numbers just don't stack up. There's a lot of hot air in this. And I think a lot of people are sort of telling you what you want to hear rather than what the real world situation is. And you must see it in portfolios all the time. People think they've got a great portfolio, but it's really actually a bit of a lemon and not performing very well.
Even to this day, this week, we get to see, fortunately, in a lot of circumstances and unfortunately in others, where people have really made some poor decisions, but to be fair, the advice that they were given, which is why they went there to begin with, was very incorrect.
Yeah.
And there's a massive dollar value repercussion for that.
So hopefully they can avoid making these mistakes by potentially looking how we do stuff. So the philosophy was, let's tell the story about creating a real portfolio and share it warts and all. And we've done that on smartpropertyinvestment.com.au. Steve's in there during the way, which has ranged from more significant renovations like the property we have out in Cambridge Park, which is near Penrith in New South Wales, all the way through to that very bold and ambitious plan that we said we'd renovate an apartment in 3 days, which we did over a long weekend in Mount Druitt on Luxford Road out there.
Do you know, out of the whole portfolio, that is probably the most resonating memory that I have across the whole portfolio, because that was like a TV show drama without the drama.
Yeah.
That's what they create TV shows around. Like, how do you take something from what it is to a brand new premises essentially over a weekend?
And we did it to show that it can be done.
It can be
done. And it can be done the right way, and we could do it without blowing it. I think we set ourselves a $15,000 budget on it. We came in a couple of bucks either side of it.
Literally a couple of dollars over.
But that included the bacon egg rolls to keep the Tyler sweet, the couple of slabs of beer I had to get in there, to the beer economy, to beg, borrow and steal help from people. So, was it really $15,000 if you priced up all that labour and all that other stuff? Yeah, it was a lot more. But guess what? It only cost me a couple of slabs of beer and it still got done. So what we wanted to show is how to go about doing it. And that's been the philosophy of the Smart Property Investment portfolio and why we're sharing this all the way through it. So we're going to do a lot more of it moving forward. We're going to give you a lot more numbers, and we're just redeveloping now. You probably, by the time it happens, this part of our website, so you can really get stuck into it. But let's start at the end, Steve. And for those people who aren't familiar with our portfolio, by and large, it's a good portfolio and it's performed very, very well. But when you break down some of the mechanics of it, you start to see some of the circumstances which makes this portfolio unique to us, which might not apply to other people. But I think what it's clear is that you need to assess and analyze your portfolio regularly, and you've got to be absolutely honest with your portfolio. You can't pretend there's certain numbers aren't in there just because it sort of doesn't really matter, or that's not like that, whatever. So when we look at our portfolio, we think of it pre-tax. So what is the cash position, number one, and then we overlay it with the performance of that portfolio. So to start at the end of it, this portfolio, and this number has jumped probably over the last year or so as a result of a lot of our mortgages changing from interest only to principal and interest. So it's always cost us circa sort of $65,000, $75,000, $67,000 a year pre-tax to run this portfolio. Today's number is $100,000, of which about $25,000, $26,000 of it is principal payments. So that's the top number, $100,000 divided by 18. And you start to think, well, it's $5,000 and a bit bucks per property per year for us to hold this. Now, if you only had one property and you had to find $5,000 to cover it, you probably, as a cash flow percentage, it's not a bridge too far for most property investors. When you times that by 18 and you get a six-figure number, it starts to become a lot more of a headache.
Starting to work the second job stacking shelves at Woolies.
Absolutely. So that is the real world picture of this portfolio. It costs us, we need to find $100,000 a year to run the cash flow on this property pre-tax. Now, post-tax, and we work really close with our accountant, Munzarul Khan, who's been on the portfolio before, who works with us and talks with us about supporting the best tax position possible. So that's outside of this conversation today. But the reality is $100,000 per year to keep this portfolio going. Now, if you take away the principal payments, it's $77,460.01. So what that costs us on that basis is $4,303.33 per property per year to hold it.
I love the accuracy.
You like it?
I really do.
Steve, maybe you can talk to this Phil Tarrant spreadsheet you got here.
Trademark.
Yeah. Like, it's pretty detailed, right?
Look, I'm in a fortunate position. I get to see a lot of spreadsheets, and this is right up there with them. For those that love a good spreadsheet, maybe ask Phil for his. You're continually scrolling.
There's a lot of scrolling.
It is. But to be fair, every one of these cells is a measurement of something. And when you've got literally millions and millions of dollars on the line, I think you need to be this sophisticated.
Yeah. So, Steve, let's not go into individual properties today. We'll leave that for another time. And in particular, I want to chat about the property we have in Kingston, but I think we can do that as another chat because we need to do some work up there. So I think that's a discussion all in itself. But for our listeners who aren't familiar with this portfolio, the type of numbers, top-line numbers that I highlight in this portfolio, and not an individual property, but as a portfolio level, I have a number here for the total policies I pay every year in terms of insurance, $15,940. I have our total purchase price. So what is the total purchase price of the portfolio? $4.314 million. Then I have a total establishment cost, $4.745 million. So that's the difference between what the property costs plus all the other stuff you need in order to buy a property, stamp duty, legal fees, all this sort of stuff, right? So that's a very, very important number. So that's what the cash position, the cash costs us to acquire this portfolio. Then I have a very important number, total debt, $5.010 million. I have a number here for total renovation costs, just to know how much I've spent in manufacturing equity. And then I have a total valuation, $7.520 million. Then I have a number here, growth on purchase price, 74.31%. Not bad. And then I have a total equity position. I have that framed at total equity, then equity at 90%, 80%, 70%, and then an offset position, and then the complete equity. So total equity, 2.509610.79.
That's a really important breakdown, the way that you've done that, because if we're looking at it from an access point of view, well, not everybody's going to get 90. Most people should get 80. You might get 70. So to have those numbers in front of you when you are adjusting saves you a mountain of work.
It does. It does. So like, I know here at 80% equity, I can pull $1 million out of the portfolio if I wanted to. And that's a mechanism that a lot of investors use as the utility to grow and evolve and purchase more properties. So it's a conversation again for another podcast about what we're doing in this property portfolio moving forward and the type of stuff that we do want to acquire as part of it. So that's sort of the performance side of things, right? So, if you look at, there's a P&L part of stuff, there's a balance sheet side of things, right? So a big part of this portfolio, next part of this spreadsheet is the operating cost. So this is your P&L. So, and you can speak to this, Steve, your portfolio is only as good as your ability to hold it.
Absolutely. You can have all the equity in the world, but if you haven't got the cash flow to support the debt, you've got nothing.
So on our expenses side of things, I have a P&L side. We look at revenue. Gross revenue for us is $316,000. Now I have an adjusted rent assuming 5% vacancy is the number I use. So that's $300,000 or $105,000.
And that's based historically on the portfolio.
Yeah. You think 5% is reasonable?
I think
vacancy? Some of the stuff I had is a lot worse than that, to be fair. But
and some of it isn't. I think it's something that, I personally adjust mine every couple of years on the historical data of the portfolio.
What do you operate at? 5? A bit more? 10?
For vacancy?
Vacancy.
What do I count for?
Yeah.
I don't do it that way. I contribute or theoretically contribute to the holding costs per property.
Okay.
So that it takes into account repairs and maintenance, potential vacancy and whatever it may be.
All that sort of stuff. Okay. Let's get into expenses. So that's at the revenue side. So obviously revenue comes in the door and then what goes out gives you your net position, basic 101 stuff. And if you don't understand it as a property investor, don't invest in property.
From the start.
That's great. Yeah. Go and get educated. You need to work out how much money comes in versus how much money goes out. And the bit at the end of it is either going to be in a positive position or a negative position.
Yep.
And your position is always going to be different to every single else's position. And we can have a chat about how all that works.
Yeah, and potentially how you put the data into the sheet.
Yeah, all that sort of stuff. But we'll go to a break beforehand. When we come back, we'll chat about some of these operating expenses because this is where the challenges we have right now. Back in a moment.
Love property? The current Buyer's Agent of the Year and Director of Pure Property Investment, Paul Glossop, does too. And right now, he's offering you the chance to secure his best-selling book, A Surfer's Guide to Property Investing, absolutely free. Simply jump on Pure Property Investments Facebook page, hit the message button and type Smart Property to claim your free book today.
Welcome back, everyone. Phil Tarrant here, host of the Smart Property Investment Show. It's portfolio update time. We're breaking down the Smart Property Investment portfolios, what I love doing. Here to join me to have this chat, and we're going to be doing a lot more of them into the future right across the portfolio with a whole bunch of different people involved in it. Steve Waters from the Right Property Group. Now, on the expense side, expense is important and good expense management is critical. So to give you all a sense of the top line expenses, and to be fair with property, there's not too many expenses. You know, they're pretty standardized. You have your interest expense, then there's the management fees. So if you use a property manager, the cost to actually get that done. Water rates, council rates, strata, if you have units, insurance, maintenance, and property management sort of admin fees. So they're the expenses pretty much every investor can expect to have. And then unique to us and unique to some other investors is land tax, accounting fees, asset returns, and all this sort of stuff. So that's probably specific to how you hold your properties.
And how you start from the beginning.
And this portfolio straddles 3 different property trusts, which have their own ownership structure and all this sort of stuff. And, you know, we'll get Munzel to come and have a chat about our setup and the pros and cons of actually using that particular structure. Works for us, might not work for everyone. And one of the expenses here, Steve, which is more specific to us because of our structure, is land tax, which costs us $38,000 a year in land tax. And that's purely because we get no land tax breaks.
And that is a big component of the overall net position.
Absolutely. And the way we structure this, and obviously we're talking about complicated numbers now and trying to be as visual as possible, we break down the expenses at a portfolio level, but we also do it for every single individual property. So I'm talking about the aggregate. We break it down based on those top lines. So the operating expenses, so interest, management fees, water rates, council rates, strata, and then our overhead expenses, which is accounting and land tax. And then I frame that as a percentage of total fees, just to give me some sense and balance. And I do that to try and benchmark if there's any anomalies. And I do that at a portfolio level, but I also do it at a property level. So a percentage of expenses versus valuation to see how that changes across the portfolio and if there's any red flags. So maybe, Steve, you can tell me whether or not this is normal or usual. In terms of operating expenses, the biggest expense we have by far is interest expenses. So this is to have a mortgage.
Yeah, that's typical of everybody.
That's typical, 58.2%. And the next biggest expense we have is a land tax, which is 9.5% of the total expenses. And then after that, council rates. Then after that, maintenance. And then it gets into smaller numbers, say strata or insurance and such. Insurance is 5% of our total expense base. So 60%, is that what you normally see in a portfolio in terms of interest expenses?
That's an interesting question because everybody has a different setup. If we were to eradicate just the land tax component percentage, it would change the figures completely. So to say, is it normal or is it not? There's no definitive answer to that because everybody has a unique situation. And that may not be from a financial point of view. It might be just, as in this case, the way that the portfolio and entities, I should say, were set up from the start.
So land tax is an interesting one. And we're in an environment right now where they're thinking about or reconsidering stamp duty. And one of the outcomes of that, well, there's 2 potential outcomes if they do eradicate stamp duty on the purchase of properties. And one will be everyone is taxed on the land component, and or there's a change to GST. So they're going to have to get their money back somewhere. In some states, New South Wales, for example, or Victoria, it could be upwards of 25 to 30% of all government revenues is through land tax, right?
Yeah. And I think if, as a side point, if people think if they were to eradicate stamp duties, that's the end of the story, they're sadly mistaken. What they give you with one hand, they will take with the other.
Yeah. So we're already getting hit with land tax. So with land tax, it depends on the structure you invest in and where you're investing. In New South Wales, for example, if you're investing individually, you get up to a threshold where you don't have to pay land tax. Once you hit that threshold, you start paying land tax on the increase over that threshold amount. So what a lot of people do and a lot of investors do, you might put certain properties into a husband's name, certain properties into a wife's name, or whatever the structure is, and then you can get some benefits and breaks there. Once you get over a threshold, you might start investing in trust. Investing in a trust in New South Wales, you get 0 land tax exemption, so you pay it from
day one.
From day one. In Queensland, for example, is a little bit different. You actually get an exemption within a trust up to a particular amount, but then you can create another trust and get the exemption again. So every state is different, and it's a bit of a minefield. You should really get advice on that stuff, shouldn't you, Steve?
Some good advice from the very beginning.
Yeah, absolutely. So quite a lot of there in interest, but you would expect that. And that's a balance and blend. Some of our properties have, probably 3 of them have 2 mortgages on them, and that's a result of doing some renovations and revaluations at a point in time. The majority of our property is on interest only. There is, I will tell you exactly how many are on principal and interest. There is 5 of them on P&I mortgages, which costs us sort of 25 grand or so a year, which we're satisfied with. It's all okay. We're not going to worry too much about that. Helps sort of paying down the debt.
Well, it's buying an equity position.
It's buying an equity position, doesn't it?
Yeah. I think the interesting point here that everybody needs to understand, and whether it be in this portfolio or others, whilst the interest rate is a massive component, well, is the biggest component of all expenses, we really need to drill down into what the interest rates are and what the product type is, whether it be interest only or P&I, because that's going to have a direct effect to the bottom line clearly. Now, we've had rates that have been for the downward trajectory now for the last 12 months, but it wasn't too long ago either that there was a point in time where everybody thought that the cost of money was going to increase. And so a lot of us fixed rates, saying to ourselves, well, you know what, we're happy with this rate. And we can sleep at night knowing that for the next 2, 3, 4, 5 years, whatever it may be, that our biggest expense is now static. But along comes different economic scenarios and the trajectory of the rates have gone down. And I would probably argue that in your case, with some of your loans, there'd be up to 1% difference.
And we'll get into that in a moment because, we're talking about expenses right now and this has been the biggest cost. But the challenge you have with a portfolio is that you're only as good as the decisions you make with the information you had at any given time.
At that point in time, correct.
And this is the balance between controlling what you can control versus leaving it up to the world to work out how things happen. Who would have predicted COVID-19, for example?
Yeah, I don't know of anyone.
No. Even that guy who's been predicting 40% decreases in property didn't predict COVID-19.
No.
By the way, he's been predicting that for about 20 years. So
it'll rain one day in a drought.
So this is the makeup of the portfolio right now. So, at peak, the balance between, and a lot of people get this wrong, Steve, they get so obsessed with capital growth and they don't think of P&L.
All the time. Yep. And this is where the danger lies because sooner or later you will get caught out. Even if you take a time. Like we have today where, cash flow has become far more relevant as opposed to what it was 6 months ago. And whether you like that statement or not, it's the truth because there was a time 6 months ago where people were more focused on growth and not really worrying about the cash flow components of a portfolio. And that, just as it did during the GFC, is starting to do that 180-degree turn where people say, we need to check ourselves here.
Yeah. So, at a capital growth or a capital performance level, let's have a chat about that, Steve, really quickly. It's not a bad portfolio, is it?
I like it. Could it be better with some modifications? Absolutely. Could it have been better if we had made some more timely decisions? Potentially. But it is what it is at the end of the day.
So in order to build this portfolio, we originally ponied up some money, by memory, sort of 200, 250 grand. And we've spoken a lot about this. You can go and listen to other podcasts around it, a lot of stories around it. But the portfolio doesn't owe us that money anymore. We've pulled it back out.
It's an important point. You've recycled the capital, which is then perpetuated into other things.
Well, we recycled the capital numerous times and we rode the wave of good growth in Sydney. And then we finally pulled out that money, the 250, and it's in our back pocket. So essentially, this portfolio, inverted commas, owes us no money. It's self-perpetuating manufacturing, but we had cash flow in order to do that.
You had the cash flow in order to do that, and that's why the portfolio exists. If the cash flow wasn't there to begin with, it'd be a completely different looking portfolio.
And, and I guess it's a sense of time as well. We're speaking about, late 2011 when we purchased the first property. Could you actually build a portfolio like this now with $200,000?
Look, I'd probably say no because it's a different set of circumstances here, and probably the main one would be around the lending.
Yeah.
Especially,
it's a lot harder to get.
Yeah, it is a lot harder, even though the rates are far lower. Because when you started, it was circa probably 6 to 7% or thereabouts.
Yeah, and I thought that was pretty cheap.
We all did back then. But today, you wouldn't be able to have the acceleration that you did if it was today, as you did back then. But it's not just because of funding. We also, timing of the market was...
timing was great.
Was exceptional.
Yeah. I think back and, I think back to some of those auctions we went to and we walked away because of like it went $1,000 or $2,000 over what our price was going to be, which might have only been 250 grand. So it's a tiny percentage of the total amount. And where we are today, like you just think $2,000, like.
Yeah, there's an argument in that though,
Yeah,
because and you could say to yourself, well, back then you could have thrown a dart at the board and just bought anything at advertised price plus 10%, and you'd still be in an awesome position today. But you don't know what the future holds, so you need to base the decisions on that day in that market at that point in time.
And this is it, and because we made those prudent decisions then, we're fortunate enough to be talking about this today. But who knows? Who could it imagine if we got 4 or 5 more properties back then? Could have we weathered the cash flow? Probably. Did we have the time and effort to do it? Probably not.
But it's
would it be
the time and effort. Well, there it is. But look, we've also got to be very fair that there's an element of risk involved with anything that you do. Did we predict this type of growth? No, we didn't. That's the simple truth. And nor, I don't believe anyone could have.
Yeah.
It was over and above normality. It was over and above averages. We'll take it without a doubt. But the numbers on purchase were based on the fact of normal growth, if you will, as opposed to accelerated growth.
And, a lot of this also is, it's like a good artwork, right? People think it's different and everyone's got their own view, whether it's effective or not. What we do know about this portfolio, absolute 100%, is around all the costs, around the sort of P&L position, what it costs to run the portfolio. We know what the interest rates are. We know the performance in that. We know absolutely everything. The one unknown out of all this portfolio, or where it's potentially a bit grey, is total valuation. So one thing we just don't know until you truly realise the value of your portfolio at a point of the mechanics of a sale. It's paper money at the moment.
Well, it is. And it's an interesting point too, because there's different types of valuations. We have a bank valuation where a valuer walks in and gives it a value.
Typically for the purpose of
a refinance. Yeah. Now, but even if we break that down further, there's the desktop valuation, which is a data-driven valuation. We have a curbside valuation, then we have a walk-in valuation, and all three on the same property could be very, very different. In fact, if you go back to the Wyong Road property,
that's right, up in Berkeley Vale,
where there was over the space of a week with 2 different walk-in valuations. I can't remember the numbers, but I think
$50,000.
$50,000.
Yeah, I think so. 50 grand. 2 days before Christmas, and then I think just after. Maybe it was just before New Year's.
And the 50K was like a representation of about 15%.
That was a lot.
Or thereabouts.
Yeah.
But valuations are supposed to be subjective, but they're just not.
Beauty is in the eye of the beholder.
It is. So if we've got a refinance, we'll frame it up that way. If we've got a refinance valuation type, could actually be very different than a sale valuation on the same property. And we see that quite a lot. So to your point, the value won't be realised realistically until you sell, if you sell, where it becomes then a tangible piece of money in your bank account, or you refinance and draw down and go and buy your Bentleys or whatever it may be. But at that point in time, everything's paper. You crystallise the win or the loss when you sell or refinance.
So I look at this, it's got $2.5 million of equity in it. I don't feel any wealthier as a result of this portfolio. It's just a headache, really.
Yeah.
You know what I mean? It's like, so what?
Yeah, there's people now listening to that comment going, what, $2.5 million? It's like, oh, what?
But you know what I mean?
I do.
You can't do anything with it. The only way you can extract it is to flog some stuff, which comes as a cost. You got to pay people to do that, to realise it. Or you got to refinance, and that comes at a cost as well, because it normally means you're taking on more debt.
Well, the cost would also be time, effort, equals debt, equals what position you're in. But this comes down to the asset type.
Yeah.
If it was a share, there'd be more of an instant gratification.
You can sell it down and you can,
in 30 seconds.
Go to the casino the next day, right?
Yeah, but it's an instant gratification model where potentially, I know some people slam me for that comment, but property's not. You don't buy a farm thinking it's going to rain tomorrow.
And this is the big discussion, again, get educated around this, is liquid versus less liquid asset classes. And property isn't particularly a liquid asset class, which has positives and negatives.
It can be. And this is the point. So, and that is the main battle, if you will, between shares and property, is the liquidity component. But property can be liquid, and it can be liquid via redraw facilities, lines of credits, but offsets or whatever it may be. So there is an element of liquidity in there as long as you do the hard work to get it to that point.
And that's a really good point, right? Having offsets in my personal portfolio, which isn't part of this portfolio, I keep a whole bunch of money savings in offsets. So I'm getting utility of that, and that it saves me whatever the portion of the interest that I'm not paying on that, but it also gives me utility to actually go out there and use it when I need it.
Correct.
But that's where I keep my sort of sleep at night type money. You know, so I know I've got that portfolio covered.
And a different type of portfolio again versus this.
This one. Yeah. But so the thing is, and maybe, Steve, this could be, and I'm always about self-reflection, critically analysing how we're doing stuff. Maybe one of the things that can be improved as part of the way we manage this portfolio is to actually have a refinance valuation and then a market valuation, two different numbers that you've spoken about.
We're missing the third one, which is a sale result.
A sale result.
Yeah.
And you'd like to think that a market valuation is akin to what you should get at sale.
It's not. It's not. Like, there have been thousands of times where I've seen something value at less than what, if you put it on a contract price, it would value at.
Yeah.
Because, whether we like it or not, there's a different thought process behind the valuation models, if you will. And I know some people will critique me for saying that, but I see it weekly.
So ours is pretty much a market valuation, just based on what other stuff's selling for at the moment is how we base the valuation on this.
Which would fluctuate too.
Yeah, I know. And I was going to say, we're saying it's number so small, 7.520 million, right? Like, people are going to go and check it out on the website. We'll put it up there and see, but people will probably have a pot shot going, there's no way you get that, or that's undervalued, right?
Or it might be overvalued.
And how often though do you actually, do I need to quickly go back through this post-COVID or during COVID and say, it's taken property in Sydney, for example, they reckon it's dropped anywhere between 5 and 10%, but it depends where you are. So what do? Do I just take 10% off the value of this portfolio immediately?
It becomes, I think that's probably an egotistical metric because do I do it to my portfolio? No. If I go back to, let's just use, the APRA handbrake as an example, affected valuations across
sort of 17, 18.
Yeah. So it affected valuations across Australia, no matter what anybody says, whether it be by 30% or 1/3%. COVID potentially has affected some areas, and so too does the ebbs and flows of supply and demand, even in accommodation. So I'm talking from a rental market in some of the areas that are more rental orientated or tenant orientated. If a glut of property comes onto the market, it may short-term affect the valuation of the property. And even if we go absolutely left field in this portfolio and look at we'll call it the Aquachip property on the Upper North Shore, when that's running, it's running really well. And when it's not, like when you potentially something like today, well, they're more akin to some slighter fluctuations.
Yeah, and it's a really important point, Steve, because valuation and equity position, it's largely irrelevant. And stay with me on this to my earlier point, a lot of it's egotistical, right? It just doesn't matter how it is today. It's like looking at your stock price every day, how it is today, how it is tomorrow, how it is next day, how it is in 5 years. When you start thinking further down the path is when you need to be considerate of this sort of stuff. But at any given day to change the number, it just doesn't really matter. It's all about your ability to hold on to an asset over time so you can realize the value of it. And this is absolutely all about what your end result, what your plan is as a property investor and how you want to realize your asset base at a point in time and your ability to hold it. The important part of any portfolio is cash flow, any given day.
Every day. Always will be, always has been. And it really doesn't matter of the equity position in the portfolio, to be fair.
Yeah.
Because if you think about it with a long-term goal of retiring debt, well, then the cash flow is still relevant because that's what's lining the pocket.
And when you actually retire the debt, it's what's kind of, come in there. So, and I've got a question, is like 7.520 million. Last time we sort of did this val and market sort of valuation, we've got some properties, Steve, we've got Malley Street here at 580. What do you reckon?
I think it would be at that as well.
Yeah.
Because of the uniqueness of that block and its position, maybe a little bit more, but I'd say the same.
Who knows? And those properties that we bought, that block of units at 200 grand each, we've got them valued up at 225 at the moment. That's pretty much what they're selling for up there.
Yep.
So you got to go, well, it might be 5 grand out, might be 10 grand out, but.
Well, and once again,
I'm not tapping into it by trying to refinance it. So therefore it becomes an ego metric.
But look, I think you should always take stock of where the equity position is. But if your nature is that of where you need to know daily, well then property is the wrong investment asset for you.
So liquid versus less liquid.
Well, it's measured versus not.
Yeah.
Remember, if you take shares, they're measured, by the second, literally, whereas property, data is 3 months lagging.
Well,
all
some
the time.
probably, I was just looking today, a lot of aviation stocks like Hello World and Flight Centre and this sort of stuff. Like, I think Hello World's up 60% from its bottom, in March, April now.
Well,
if you put $1 in and get $1.60 back, a couple of hours, that's pretty good going.
Well, there's one better. They're one of the crypto stocks is up 1,000% since March.
It's crazy, isn't it? So this is why you need to be diversified. Good layer of diversification in your assets.
But that, it's a dollar in for $1.60 back versus 20 cents in for $1.60 back.
Yeah. So that's how we frame the portfolio. So go and check it out, smartpropertyinvestment.com.au. Don't get too carried away by the valuation. It's a bit open for discussion. It's not really worth debating it that too much, but everything else is the reality of it. We know what the interest rates are. We know what it costs to hold the property.
You mentioned a really interesting point there is, let's not get into a debate about it. I think the thing that I'd encourage people to look at is the actual cost center and the cash flow, because that is something that you can influence.
Yeah.
Sometimes it just takes a little bit of time.
Yeah, and I measure this also as in terms of expenses. So the percentage of expenses versus valuation is one of the ways I look at this, 5.36%.
Yeah, how deep do you want to go?
Yeah. And then I've got another metric of percentage of expenses versus equity, at an aggregate level, but the reason why I do this, and this is a really good one. So what's the expenses of the portfolio versus the equity that I have within it? That's one measurement. But at an aggregate level, largely irrelevant, unless you want to benchmark it against other people's portfolios, but that's largely irrelevant as well because everyone's circumstances are different. But the reason why I do that, and if you've got a portfolio, go and play with this, right? I wanted to see how it was property compared to property, to see whether or not there's any huge anomalies, as in, holy shit, pardon my French, I'm paying so much more in expenses for this property versus the equity position in it. Something has to be wrong. And one of the main reasons why I run this portfolio is it allows me really quickly to work out where are the red flags and I've got to do something about it. And we'll get into that after we go to a break. But Steve, this metric of percentage of expenses versus equity, it fluctuates from 11.25% and 9.77% on some properties in the western suburbs of Sydney, all the way to, there's one here at 20.71%. And that's a property you mentioned up on the North Shore in Sydney. Go and check it out in Mount Ku-ring-gai. That's a big number. There's another 20%, 22% for a couple of properties I have up in Queensland. And that newer stuff, those properties up in Lawton, where we bought a block of 5, they're on the high side. Low value, but pretty much standard in terms of council rates because they're strataed. I've got to pay council on each of them. I've got to pay water. I've got to pay big insurance on it. So this is just a metrics for me to actually look for where the red flag and the outliers are and going, what's going on there. And let's go to a break. When we come back, let's have a chat about what we can do with the portfolio to fix its cash position. Back in a moment.
Worried about making the wrong choice with your next investment? You're not alone. If you truly want to become the master of your own lifestyle design through real estate, then you need to speak with Buyers Agents, who'll help you acquire cash flow positive properties in high growth areas with value add potential, so you can create more freedom in your life. Visit dashdot.com.au/SPI.
Welcome back, everyone. Phil Tarrant, Smart Property Investment with Steve Waters from the Right Property Group, chatting about our portfolio, the Smart Property Investment portfolio. Go and check it out, smartpropertyinvestment.com.au. Now, Steve, I remember I sent this sheet to you and I sent it over to Munzrul Khan as well, my accountant, probably about 3 weeks ago.
Yep.
Probably late in the evening after I'd sort of been spending time getting frustrated by it, looking at red numbers on it, $100,000 across the hold it going pretty much, and I'll paraphrase, something's wrong with this is all crap. What's wrong with it? Interest rates are so low right now. Why is this thing still costing me in cash flow, including the sort of principal repayments, $100,000 a year or $5,000 per property? This is, by memory, the email was something along the lines of, these people that go out there saying, go and buy positively geared properties, it's all a load of BS and positively geared properties don't exist. It was pretty much the basis of, it was a bit of a rant, right?
It was a bit of other stuff.
Bit of a rant. There's a couple of expletives in there. So what this portfolio is a product of our circumstances at Smart Property Investment. Now, that number there, the cash to hold this property, $100,000, you can make that go away overnight if I paid down some of the mortgages. I can make that go away overnight if I had a huge bunch of money in an offset somewhere. I can make that go away overnight if I change the interest rates. So they're things I can control. But the reality of actually chucking a whole bunch of cash in, that's not going to happen. I can't change the cash position on it. I can't do anything more in terms of the operating expenses. outside of interest. So I've negotiated pretty hard on management fees. It's not going to give me much. Even if I move 1%, it's not really going to change that much. Can't do anything about water rates except for making sure everywhere where I have a house that I can charge the
Usage?
The usage. Not really a lot of money, maybe $50-$60 a week at best.
Over the portfolio?
No, per property.
Yeah, but see, and there
But
it is.
it all counts up.
Yeah, right. There it is.
Can't do anything about council rates.
No.
I can't do anything about strata.
No.
Can't do anything about insurance.
You can do something about strata.
Yeah, can't do anything about insurance. Well, I could try and negotiate a better rate, but it's going to be marginal, right?
No, and I'm not. This is not at you. I'm just being general. Pay the strata on time, and it's 20% discount.
Is it 20% discount on strata?
Sometimes in some of the complexes, yeah, it is.
Okay, interesting. And I predict for houses $2,000 a year in maintenance, townhouses $1,500, and for units $1,000. So can't really do too much about maintenance except for be more proactive with maintenance and therefore minimise. But what I'm saying is that there's a whole bunch of costs here that I cannot control too much, right? I can pay my stuff on time and get a bit of a discount, right? Yeah, there's going to be roundings on decimal points to be fair, but every single cent counts. The one thing that I can do, and let's have a chat about it, is the interest expense, which is, the biggest individual cost at 58.2% of our portfolio is interest, and they're high. Like we fixed some of them on the basis they were way too high, and we thought we're going to get a really good. We fixed them at 4.5%, I think, or 4.6%, and we thought we were doing well. And this was back when we're trying to reduce the cost base to hold the portfolio. But now we're stuck with some interest rates at 4.5 and P&I.
And this comes back to you make a decision at that point in time that suits, and we can reflect on it. And maybe some of the interest rates or the decisions to fix were a little premature, maybe. But sometimes we don't have those choices and we need to execute there and then. The calcs I've done is that, and this is not taking your rates to 2.88. This is taking them to mid threes. And there's somewhere between $25,000 and $35,000 saving in cash flow off the bat.
Yeah.
I want to repeat that. That's not taking it down to 2.88, which you can get.
Yeah.
But taking them to a mid three scenario.
Which is what we need to do. And I'll tell some of these banks on here, you're on notice that you're going to be getting a phone call from Phil Tarrant. And he's livid at the moment. And how you're charging him way over the standard interest rate. And this is something that you do have control over. And I don't know how hard to go on this because I don't want to. I don't want to get any calls from any bank CEOs. But if you're listening to me, banks, it's such a supply and demand type of thing. But if some banks are offering high twos for interest-only interest rates right now, and I'm paying mid-fours, there's a bit of a disconnect there. So it's either someone's taken the piss out of Phil Tarrant or every investor out there in Australia, or Phil Tarrant's just an idiot because he hasn't gone on the phone and said, Mr. Banker, why are you charging me more than everyone else?
Probably a bit of truth in all those statements. I'm in a fortunate position. I get to review a lot of people's portfolios on a weekly basis. I've probably done 100 in the last, 2 months. And so I'm privy to see what other investors pay.
Yeah. And
there are lows of 2.56 interest only. And that just made you sick in your own mouth. But all the way up to 4.99s still.
Yeah.
But there's middle ground there somewhere. But I would have to say that the average investor at the moment that I get to see is low threes.
So I'm not going to actually highlight any particular bank because it's not really appropriate, but I'll rattle through some of our interest rates here. 3.94, 4.29, 4.29, 3.94, 4.34, 4.26, 4.31, 4.19, 4.15, 4.15, 4, 4.54, 4.34, 4.34, 4.3, 4.3, 4.19, 4.19.
Yeah, I just had a vision as some of the listeners sitting back listening to that and just saying, you've got that amount of loans?
Well, no, there's more, 4.19, 4.31.
But look, but it's an extremely established portfolio and those rates are over the top. Yeah. There's no ifs or buts about that.
There's one under 4.
Yeah.
There's only one under 4, 3.94.
But let's also be fair. There was a time there where, going years back, that we all were saying that if we could get something with a 4 in front of it, we'll lock that down.
Happy days.
Because history, we've been through that before where rates were 6 and 7%. This is a different time.
Yeah.
That doesn't mean just because it's different that it won't potentially be the new norm for the foreseeable future because of the economic circumstances that we have today. But it also doesn't mean that you should just say, this is where I am. I won't do the hard work to increase/reduce my costs and cash flow.
Yeah.
Because to do that, especially if a portfolio of this size, let alone someone who has 1 or 2 properties, It is hours of work.
Yeah. And how many properties you got is largely irrelevant. You know, you should have the same philosophy irrespective if you got 2 properties, 10 properties, 50 properties. It's incumbent on you to take control over your own portfolio fortune.
So here's a question for you. If I came to you and said, look, 1 Smith Street, let's put the rent up by $50, you'd be stoked.
Yeah.
Then you should have that same enthusiasm. Let's save $50 because that saving of $50, you'd have to earn $75.
Yeah.
And people tend to focus, not rightly or wrongly, but too much on the income side of things rather than the expenses.
It's a good point because, our total income, $16,000 less 5% discount for vacancies, $300,000 on the nose, right? Now, there's 18 properties in this portfolio. To actually, the hard work and effort to lift every single, but let's say they're all the same rent, right? The time and effort to actually lift to try and get $10 or $20 more a week in rent, it's near impossible. You just couldn't do it in this environment. It's not even worth trying or hoping. Like, you don't move the needle at $10 a week. What's that? $520 a year,
Yeah, but for some people, that's a lot of money.
It's a lot of money.
It's more to the point of, we've always said the consistency of cash flow is far more relevant than an extra $10.
Yes, absolutely. But if you think about the debt position in this portfolio, which is currently 5.010389 and 21 cents.
Millions.
Yep. 1 basis point on that moves the dial.
Without doubt.
0.1 of a basis point moves the dial, you know.
And it's better than, as I said, it's the equivalent of 1.3 times, 1.4 times a rental increase, just because it's a net position straight off the bat by reducing the cost.
Yeah. So what do I need to do, Steve? It's glaringly obvious that the performance is the performance. I can't change it too much. I'm in the hands of the market to see whether or not these properties are going to go up or down. I'm not in the business at the moment of manufacturing equity in it, so let's put that aside. That's one way you can actually change the performance of portfolio, and that's for another time, I think, for us to discuss what we can do. Maybe there's a granny flat we can put on somewhere. Maybe there's a reno we can do, whatever, right? And that might give a capital growth increase or maybe a rental increase, right? But let's put that aside for a moment. By and large, I've thrown this portfolio into the market and hopefully we've bought well and it should go up in value, right? Let's hope so. Can't control economic conditions, can't control what the government does, can't control buyer consumer sentiment, can't control a whole bunch of different things, right? So not a lot we can do there. I can't do too much on the expenses because by and large they're fixed. I might be able to get a couple of grand a year if I pay stuff on time or whatever. I'm not going to be able to change the revenue on this any given time because vacancy rates are pretty high. It's moved into a tenants market rather than a landlord's market. Can't really twink with that. But I could probably shave 20 to 30 grand off the expense if I get my mortgages right. In terms of prioritisation, that's where I should be focused.
100%. Control what you can influence.
Yeah.
And that's your expenditure at this point. But that's also, if you shaved a bit here and a bit there, which might be another $2,000 a year.
Which matters.
It's a good holiday somewhere.
Yeah. Well, yeah, $2,000 is about 0.5% of the total portfolio operating costs.
Yeah, it is. But this is where, for some, they really need to be putting a firewall between, the percentage decimal point, which might be 0.01 and doesn't sound too attractive versus, well, hang on, that means $2,000 to me.
$2,000 is a lot of money.
Yeah, so don't get too caught up in the percentage points, get caught up in the dollar.
Absolutely. So, and this is the important thing. You've always got to frame it in the, if you go to anyone, I don't know, anyone who would go, I'll give you $2,000 and I have $2,000. I'll have $2,000. I could pretty much buy a new set of tyres and get a new engine for my car that doesn't run very well, right? Like $2,000 is $2,000, you know?
Every day.
You'd be able to buy half a new suit,
From Vinnie's.
Yeah, don't give Vinnie's a hard time.
They do a good thing.
But let's talk about this really quickly. So that's something we can control. So my commitment to our audience is that I'm going to get on the phone and speak to all these banks. I'm going to say, excuse me, Mr. Bank. What do I say to them, Steve? Excuse me, Mr. Bank. Why am I paying 4.5% when everyone else pays 3.5%?
Don't you know who I am?
Don't you? I'm that annoying guy on the podcast.
No, look, and we have had a bit of a discussion, which has worked for our clients quite well. And basically, you stack the evidence. So if Bank A with this particular property is at 4.34, and we know that in the open market, Bank B is giving you, 3.1 because that's their advertised rate. Then show them the evidence. Now, you just ring the bank and this is, brokers play such an important role in the establishment of a portfolio and the ongoing perpetuation of a portfolio. What we have found is that going straight to the lender, to the help desk, if you will, gets a quicker, better result. It doesn't bypass the broker in terms of the relationship. It's just a quicker result. And so you ring the bank A, and you say, I'd like to reduce I'll have a chat about this because over there they're offering me that. And your answer is usually no to begin with. And you say, okay, cool. Can I speak to your team leader? And you go through the same rhetoric again, and the answer will probably be no. And then ask for the retention team, right? The retention team is where usually the rubber hits the road. Now, not all banks call it, or lenders call it a retention team, but the equivalent thereof. And you just plead your case. At the end of the day, is it a bluff? Potentially, but it's a bluff based on fact.
Well, I'm not bluffing when I call up.
No,
I'm
but
going to move my mortgages if they don't give me the rate I want.
Yeah, they're all
You've been warned.
They're all probably listening now.
Yeah, just going to call. When's going to call? You know what I should do? I might. I don't know. It's probably not appropriate to actually record me making a phone call. I don't know if that's probably the right thing to do.
I wouldn't suggest you do that.
No, doubt it either.
But what we have seen when we go through that script is that it has worked 80% of the time, even if it is a couple of basis points.
Yeah. A couple of basis points to do me wonders. If I can put 30, at least, or 20 grand, I'd be happy. 30 grand into this portfolio, it brings it down to 80 in true cash, less the 25 that we provide. It brings it back to a reasonable sort of level.
And then if we took it from some of those loans from a P&I back to an interest only, well, then that accentuates the difference
But
again.
it's cash flow. I don't need to do that. I haven't had to stall any of these mortgages. Again, it's an individual circumstance.
That's a really important point. So I mentioned, taking them back to interest only if you wanted to, or whatever it may be. But because they're P&I, you're actually giving it back to yourself. Yes, the initial cash flow out is higher, but don't forget that you're actually buying a bigger stake in the property.
Yeah. And there's an important point, Steve, I want to make. There's a lot of discussion around positively geared properties. It's like the utopia, right? There's this utopia to go out there and try and find positively geared properties. And positively geared properties are cool because they put money in your back pocket, right? But at a point in time, you would hope that a portfolio becomes positively geared. Now, let's take this, for example. This portfolio is a long way from being positively geared.
It depends.
Pre-cash.
Depends.
Yeah, a lot needs to happen in order to do that.
It depends.
Yeah.
Because, and I think the point you're trying to make is if you throw a couple of 100,000, 400,000 or 500,000 into this and reduce your rates, it might be neutral. It might be a little bit positive. It really depends on how you play with the numbers and what you physically do to the portfolio. Add a few granny flats, maybe some multiple dwellings. It's how far do you want to take it versus is my capital to do that better off elsewhere?
Yeah. And so the point being is that positively geared is an individual state. It completely depends. A property can be geared positively immediately if the debt on it is less than what it might be for some other bloke.
Yeah, because you might have
some other person or some other lady.
I could make Kirribilli unit positive cash flow from day one if I put a sizable chunk of cash as a deposit.
Yeah. So it comes down to strategy.
And want.
And there is there's 2 properties, Steve, in this portfolio, which pre-tax is positively geared. That's it, out of 18.
To start.
And one is that property that we did that work on in Mount Druitt on Luxford Road to a tune of $662 a year. That is net pre-tax.
Pre-tax.
And the other property is one of the units, which, by the way, is just recently vacated. So we're trying to put someone into it now. One of those new properties in the block that we bought in Launton is positive to the tune of $237 a year.
I think what's important here is, and I want to preface this by saying, the gearing is, negative gearing and all that sort of business is a moment in time, But we can't lose sight of the fact that if you can borrow money means you're paying tax.
Yeah.
And it is your God-given right to minimise. And fortunately, property gives you the ability to do that. It should never be the reason. Let me make that really clear.
It's not a strategy.
It's not a strategy. It's a byproduct for a moment in time. And so we have a pre-tax position and we have a post-tax position.
Yeah.
Because that's a fact of life.
So the properties that are the most negative cash flow are those which are more expensive, to be fair. Like the property we're having on North Shore costs us 22 grand a year, of which $8,000 is land tax, right? You've got other properties here that range between sort of $10,000, $11,000 a year. some are sort of $7,000 a year, and then you got some which are less than $1,000 a year. So it does fluctuate quite a lot, but a handful of the properties support the case for it being most negatively geared. So, what you can do as an investor is you can actually target them individually. You can change your situation straight away. Rather than try and target all of them, you either offset a particular mortgage with a particular amount of money. But, if you get that tactical, there's got to be a good reason for it from a cash flow point of view. The other ways around it is that you can actually target them with ways to increase the yield you generate out of it. And that might be, I don't know, a granny flat or an extension or something or other. But
or
sometimes you can't do it.
Just a simple renovation.
Sometimes a simple renovation. So pretty complicated discussion, Steve. I know it's easy when you're looking at the numbers. So go and check out smartpropertyinvestment.com.au. Haven't really achieved much except for just talk about,
But it's real numbers. I think
real numbers.
Yeah, and I think that's important for all investors, or whether they are or they want to be an investor, is to actually be real with the numbers.
Yeah.
And to be fair to you, this is one of the better sheets because every expense is itemized and it's there. You haven't sugarcoated it in any way, shape or form. In fact, you've probably gone a little bit sort of overboard.
That's okay.
But that's okay because that's your personality.
But it's my personality. It's also the responsibility I have for our audience. Like I want to show this is what a portfolio looks like, warts and all, Whether or not the management has been effective, I'm happy to criticise myself. Whether I could have done a better job for this, absolutely, right? But, am I happy with $100,000 I've got to find in cash a year to run this in terms of, realising the capital growth out of it? No. I'd like that to turn into a zero or a positive.
Or a positive.
I'd love it to be positive. So I'm going to work at that. But the reality of the situation is I'm not going to chuck a whole bunch of cash at this to make it positive when that's money I can be using for other things. Right, and this is utility and fluidity. You can have money in property.
Well, it's where does the dollar work best for you?
Where's the dollar work best for me? But overall growth in his portfolio from a capital growth point of view, based on the valuation we've got right now, $7.5 million. Now, is that a true valuation? Is it under? Is it over? Who really knows? But it's there about 70% growth from what we paid for this thing, and
which is paper profit, right?
It's paper profit. But going back to property over time, there's properties down here early doors, like the 2011 properties that we bought. And I'll do a bracket from purchasing through 11, 12, and 13, right? 1, 2, 3, 4, 5, 6. So there's 8 properties that we bought during that period of time. And I'll run through their growth from property 1 to 8, 169%, 89%, 106%, 138%, 192%, 139%.
And I don't know which ones you've bracketed, but I'm having a bit of a guess here in my memory bank, but I would also say that 85% of those were forced equity via renovations.
True. North St Mary's.
Renovated.
Mount Druitt, number 1, not renovated. Mount Druitt, number 2, renovated. Micawber in Ambervale, renovated. Cambridge Park.
Yeah, renovated. Yep.
So the market's given us an uplift, absolutely, but it's been manufactured as well at the right time in the market.
I was about to say that. At that point in time, that strategy suited.
Yeah. And a lot of these, the valuation hasn't changed too much over the last number of years. We got that spike in growth, and then it's just essentially following the curve now of just those markets with their well-bought properties. But
they're also, you make a really good point there, is that we had such an initial growth spurt and not much after that because it has to get back to its average. That's what an average is there.
It's just timing the market.
And it's very important, as you haven't done in the good way, is over-leveraged. Because obviously as you leverage, whether you put the money elsewhere in another property or whatever, obviously the cost of debt or the debt increases, therefore does the bottom line in terms of negative cash flow. So you never want to be in a position that you're over-leveraging because remember that the ultimate is actually to retire the debt. And if you keep leveraging, there's never an end point.
So we're at 67% LVR at the moment. I'm sort of happy with that. That should come down over time, right? And that's the nature of this portfolio. Now, the LVR position will change because property should go up in value. Hopefully the mortgage position doesn't change too much. I can't see us getting huge spikes in interest rates over the next couple of years. So this could be the golden moment for this portfolio where you could actually pay off debt when interest rates are really low and hopefully get some capital growth upsides. But we can chat about that another time, I think, about what next.
Yeah, absolutely.
That's good. Hope you enjoy that, everyone. It's I've tried to keep the numbers reasonably simple to understand, and I haven't gone into crazy as soon as you can't understand what someone's talking about, it probably shouldn't be in property investment. So keep the numbers simple. Doesn't need to be hard. Think about cash flow. So it's profit and loss. Well, it's profit and loss. It's P&L and balance sheet, but every given day, think about your P&L, and don't get too caught up in the long-term valuation of your portfolio. Just going to make sure you hold your property and buy well would be my, not advice, recommendation.
Look after the bottom line daily.
Absolutely. Steve, thanks for coming in, mate.
Pleasure.
Enjoyed the chat. It's good. Enjoy these. Property update. Go and check it out on smartpropertyinvestment.com. You just click the button. You can see what's going on. Doing a lot more of these now moving forward. So get involved, get connected. Any questions at all, you can reach out to the team here, editor at smartpropertyinvestment.com.au, or send us a direct message on social media. Just search Smart Property HQ. You can track us down. If you like what we're doing, let us know. We love reviews. It's just not me here. There's a whole big team here who produce these podcasts who, like me, are passionate property investors, connected with property as well. They love the reviews. So wherever you listen to it, whatever platform, if you could do that for me, 5 stars is good if that's what you think we deserve. And if you want to do more of this, we're happy to do more of it. Just let us know. Happy to be responsive and creative as much as possible to changing the way in which we can deliver this information to you. We'll be back again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Propertyology regards right now as a very exciting time for investing in Australian real estate. There are some fantastic opportunities that Propertyology can help you take advantage of before buyers re-emerge from their coronavirus cocoons. Propertyology has a national focus. Now more than ever, experience and knowledge are the most valuable currency. Propertyology has that in spades. To find out how Propertyology's multi-award-winning buyers agents can help you prosper, contact them now at propertyology.com.au.